looking for a place to start your search, here are the 7 best growth stocks to buy for February of 2022. The first stock on this list is Pinterest. Despite Pinterest losing almost 60% of its value in the last 12 months, only one analyst has a sell rating for the social media platform. In addition, the average price target for pins is $50.57, providing plenty of upside for risk-tolerant investors. CFRA research analyst Angelo Zeno is one analyst who has a buy rating on pins, saying the stock sell-off has created an opportunity for investors to pick up one of the best growth stocks for 2022 at a discount. Zeno acknowledges that weaker consumer engagement and changes to Apple's privacy policies could create headwinds for pins in the first half of the year. However, a more attractive valuation, easier comparisons by the second half, and potential new strategic options, M&A, are all notable positives, he writes. The analyst adds that shopping engagement remains a massive opportunity for Pinterest and that revenue growth will come from international users and greater monetization of its current base. Pinterest reported its third quarter results in early November. The firm posted impressive year-over-year revenue growth of 43%, while monthly active users rose a more modest 1% from the year prior to 444 million. The company's international MAUs grew 4% year-over-year in the third quarter to 356 million. Furthermore, international revenue grew 96% from the year prior to $135 million. International users currently account for more than 80% of total MAUs. In terms of average revenue per user, the US figure came in at $5.55, 44% higher than the previous year, and 38 cents internationally, 81% higher than the previous year. Pinterest had adjusted its earnings before interest, taxes, depreciation, and amortization in the third quarter of $201 million, 117% higher than a year before. At this rate, Pinterest appears on its way to delivering the company's first annual profit. That's something positive to take into 2022. The second stock on this list is Trex. Following its 61% gain in 2021, Trex entered large cap, or at least solidly mid-cap territory. While unlikely to repeat the prior year's strong performance, it does have an impressive 15-year annualized total return of 25.4%. In other words, anything is possible for the Virginia-based maker of wood alternative decking products and fences. The move from wood to composite decking is expected to continue in 2022. Trex grew its annual sales and earnings per share by 17% and 20% respectively over the past 3 fiscal years. The estimate for EPS in 2021 is $2.11. That's expected to increase to $2.57 per share in 2022. Trex only got started as a business in 1996. Composite decking accounts for 25% of all decks in the US and is projected to rise by 2% annually for the foreseeable future, said CEO Brian Fairbanks in the company's third quarter earnings call. To accommodate its continued growth, Trex said late last year that it is building a new production facility in Little Rock, Arkansas. It will see the company invest $400 million to ensure production begins at the plant in 2024. It will be Trex's third U.S. plant. Not only is Trex one of the best growth stocks for February of 2022, but it's a solid pick for environmental, social, and corporate governance investors. Trex Company is a leader not only in the manufacture of environmentally friendly products, but also in its commitment to sustainability in its operations, William Blair analysts say. Trex is one of our favorite secular growth story and a play on outdoor living demand and wood conversion. They add, The onset of COVID-19 accelerated the already strong outdoor living trend, and the launch of the enhanced product line is expanding the company's total addressable market. Merkle expects Trex to grow its EPS by 15 to 20% per year over the long haul. As a result, investors can expect this to increase its share price in 2022 and beyond. The third stock on this list is the SVP Financial Group, and it delivered a total return of 74.9% in 2021 for its shareholders. As a result, it's now turned in an annualized total return of 26.8% over the past decade, more than 3 times the regional banking industry and almost double the entire US market. For nearly 40 years, the California-based bank holding company has been helping innovators and entrepreneurs grow their businesses by providing them with financial services necessary to grow and preserve their wealth. SVP Financial calls itself the Bank of the Innovation Economy, which focuses on the technology, life sciences, and healthcare, private equity, venture capital, and premium wine industries. As of December 31st, SVP has $211 billion in total assets, $66 billion in loans, and managed or administered $399 billion in total client funds. It might not be as large as Bank of America, but long-time shareholders likely don't care. Its returns speak for themselves. Also, in the fourth quarter, the company announced it acquired a New York-based research firm specializing in media, communications, and technology companies. By acquiring this, its investment bank is able to expand its healthcare and technology coverage. Piper Sandler analysts who have an overweight rating and a $725 target price on the SIVP stock recently suggested that a 25 basis point interest in the Fed funds rate would add between $300 and $330 million in revenue and $5 a share in earnings. By 2023, they estimate the bank holding company will have a total operating revenue of $8.1 billion in 2023, up from $4 billion in 2020. On the bottom line, they project a core EPS of $35.55, up from $23.58 in 2020. In other words, SIVP is one of the best growth stocks for 2022 and beyond. The fourth stock on this list is Trimble. Trimble's history dates back to 1978 when Charles Trimble co-founded the company manufacturing marine navigation products. Today, it's a leader in global navigation satellite systems and global positioning systems, or GPS, across several industries including agriculture, construction, infrastructure, and transportation. With more than 1,000 unique patents, the company continues to innovate. It spends more than $475 million per year on development and research. This has enabled it to grow its recurring revenue. In 2017, recurring revenue accounted for 29.5% of TRMB's overall revenue. By 2020, it represented 41.1% of the top line. As a result, its non-GAAP earnings per share rose 54% over the same period. On an annualized basis, the company is growing recurring revenue by about 8%. At the end of the quarter, it had $1.6 billion backlog. As its customers continue to digitize their businesses using Trimble solutions, shareholders will benefit. TRMB stock delivered a total return of 30.6% in 2021, 480 basis points, better than the US market. Analysts give Trimble an outperform rating at a $102 target price. They believe TRMB's end market will experience significant growth in 2022, setting it up for an excellent year. Despite the myriad crosswinds facing Trimble's diverse end markets, we believe the company has positioned itself to benefit from the secular digitization in the key verticals of construction, agriculture, and transportation, the analysts write. We believe Trimble will benefit from both share gains and continued migration to higher margin recurring revenue and software and services as it increasingly offers its customers integrated workflow solutions. In fiscal 2022, they project non-GAAP earnings of $2.91 per share on $3.9 billion in revenue. The fifth stock on this list is Lululemon Athletica. Argus Research tapped Lululemon Athletica as one of the best apparel stocks to buy following the release of the company's third quarter earnings reports in mid-December. Two reasons for analysts' excitement are the athleisure brand's prospects outside of North America and its growing men's business. In its third quarter, ended October 31st, Lululemon's men's business increased sales by 44% year over year to $343.3 million. This segment accounted for 23.7% of Lululemon's $1.45 billion in overall revenue during the quarter, 240 basis points higher than in quarter 3 of 2020. Lululemon sales outside of the US and Canada were $224.1 million, 40% higher than a year earlier. These sales outside North America accounted for 15.5% of its revenue, up 110 basis points from a year earlier. As of October 31st, Lulu has had 71 stores in China, up from 55 a year earlier. China now accounts for 13% of its 552 company-operated stores. Another investment firm that likes what Lululemon is up to is BofA Securities. Analysts have a buy rating on Lulu and a $420 price target. The retailer recently trimmed its fourth quarter outlook, citing Omicron-related headwinds. However, the analyst said the slight reduction in the fourth quarter forecast will prove to be transitory. And while the stock is trading at an elevated 35.6 times forward earnings, the analysts believe the premium is justified given Lulu's relatively stronger growth prospects, including a productive US rollout, rapid e-commerce growth, and international expansion. Hutchinson and Nardone analysts see many positive catalysts in the year ahead, including a return to the office combined with an ongoing casualization of the workplace, more substantial margins in North America, higher sales in Europe and Asia, and a boost from Lulu's spring 2022 footwear launch. They estimate Lulu's EPS to be $8.96, 16.7% higher than the previous year, rising to $10.35 in 2023. The sixth stock on this list is Roku. Roku was a big loser in 2021, shedding nearly a third of its value as its broader market soared. But the video streaming platform is one of our top communication service stocks for 2022, and it's a popular rebound pick among the analyst crowd. Cord cutting isn't going away. Further, with ad sales expected to grow by 12.9% over the next 2 years to $755 billion, Roku is ideally positioned to capture a larger slice of this growth. Analysts have a $340 price target that implies Roku shares will rocket 116% higher over the next 12 months. The pair expect Roku's revenues to jump by 57% across full year 2021, then 37% in 2022, and 24% in 2023. EPS should more than double from $1.54 per share in 2021 to $3.18 in 2023. Roku also has a lot of value to advertisers. Roku reported 56 million users in the third quarter of 2021 out of 120 million users US TV homes, according to Nielsen, or 46%. Over the past 5 years, Roku has more than tripled its penetration of total US homes, from 16% to about 50% by our estimate. Since each US home has an average of 2.5 people, Roku devices reaches 150 million consumers, which advertisers must access. As advertisers become more comfortable advertising through Roku, the average ad spend will increase. Analysts also point out that Roku has a very sticky customer engagement, noting that rapid consumer adoption and very high viewing hours per home each quarter suggests that Roku's platform is valuable because it owns the consumer relationship and is a gatekeeper to access to those homes for any company that owns streaming content that collects streaming subscribers or viewers. In other words, to get to the end user, content creators have to go through Roku. The last stock on this list isn't very surprising. It's Apple. From a consumer standpoint, 2022 is expected to be a busy year for the company, with Apple set to launch a refreshed iPhone 14 and some more devices with its internally built semiconductors. Expect more of the same on the cash generation front too. In the trailing 12 months ended September 29th, Apple had churned out a whopping $93.0 billion in free cash flow with a sizable FCF margin of 25.4%. Apple started the year pushing through the $3 trillion market capitalization mark. It likely will spend the remainder of 2022 trying to recapture that level and start its ascent to $4 trillion. Meanwhile, AAPL has been one of the most impressive mega growth stocks of the past few years, averaging roughly 41.6% annual returns over the past half decade. Many analysts expect this to continue. Argus Research believes that any supply chain issues Apple faces are mitigated by the fact that its sheer size puts it at the front line of producers. It also feels that Apple's ecosystem breeds success. The shares are always at risk from the perception that growth could slow as the law of large numbers catches up with Apple. The company has mitigated that risk, in our view, with the very aggressive shareholder return policies, which will likely remain paramount. Despite the company's growing largesse, we expect institutional investors to continue to demand more aggressive dividend growth and a larger share repurchase plan. Buying a stock is easy, but buying the right stock without a time-tested strategy is incredibly difficult. So it's hard to know what the best stocks to buy now or put on a watch list. These were my choice of the 7 stocks you should buy this February. You want to choose a stock on this list, as this list has been compiled through diligent research. That's it for this video. I hope you got some value out of it, and if you did, make sure to hit that like button and also subscribe to my channel for more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Thank you so much for your time, and I'll see you in the next video.